Hey, what's going on, everybody? Welcome back. Today, I'm going to show you guys a very bullish thesis on Shift. Now, I am very bullish on Shift. Just keep that in mind. Not financial advice. This is just why I decided to invest in Shift. Ultimately, if you guys don't know what Shift is, we're going to go over that. We're also going to go over a little bit baseline fundamental analysis and actually get a future valuation for this with real price targets. And then, of course, what's going to happen with the company, because Shift is a very newish company, 670 million market cap, growing at 100% a year, 100+% a year. So Shift definitely has some great potential here. But first things first, let's get a little background on the stock itself. So this opened as a SPAC back way, you guys could see right here, got announced here in June, and it had a nice run. But once the SPAC actually officially merged, it went down at 1.34% from original SPAC price, and that is to $6.60. It has since hiked back up basically to $8, but it is still, in my opinion, at a very deep discount if we compare them to other online dealers like Carvana and Vroom. So in short, Shift is a online dealer. They operate a few locations that are really just their hubs. They have a bunch in California and Texas. That's where all of their cars are stored right now. There's a lot of room for growth into other large markets like New York, Miami, and other large hubs of that nature. So they're not that different from like Carvana, for example, but they do offer really great customer service and are ranked #1 out of all of the online dealers that have very poor reputations. They have a very good customer service. It's pretty impressive what they do. I don't doubt all the reviews. I actually really am interested in this. I wish it was in my market, honestly. But from a buyer's perspective, you see the selection. Everything is certified. Everything is bought from a private party at one point. They don't do much of auctioning. They will bring cars to the auction, but they won't take cars in from the auction. So all these cars get inspected, and their pricing is always the lowest. I have to say they are always the lowest price. They do no haggle pricing. There's no negotiating, and it's already the cheapest. So there's really no reason to. The test drive, they bring the car to your house, and then if you don't like it, they don't charge you for your test drive. Nothing, no harm, no foul. And then finally, they have a 7-day return policy like most of these guys do. It's just kind of to stay competitive. Not a lot of people use that, but that is something that is big. But as for the numbers, because that's what all that really matters with Shift, it is a high-flying grower. They did not grow that huge over 2020. They had a pretty decent year with revenue, but they are expected to grow at, I think most analysts have them at around like 100 to 120. The actual company itself said 130. That's what I used in my valuation. So you're looking at around 400, 450 million, and that would take us to a pretty low price to sales ratio. Anyways, I projected this out. This is the exact Shift right here. It's a little sloppy. It's definitely not professional at all. It's just using revenues and price to sales ratio. I do not have solid margins enough for this business. They still are working on their reconditioning costs, which is basically the cost to get a car from when they buy it to actually sold. So this includes everything from detailing pictures, painting if it needs a little paint job or something. All of that would be included there. So they're trying to get that price down. It is still up there, and their margins are going to suffer until then. But I think ultimately they still should be priced at around a 2 to 3. So in comparison, Carvana, I believe, is at 2, and then Vroom is at 3. So those are the same general companies. They're a lot larger, but they are still the same industry. It's the closest we got. So I used the price sales to 2 to 3 to do my whole valuation. And at the current stock price of $7.97, might be higher, might be lower, depending on who you're watching this. Next year, if they hit 130% growth, which is what the CEO expects, that is $450 million. And at just a 2 price to sales ratio, this thing is deserving of a $900 million. But as we expect them to grow, the next year after that, it's expected around 80, the high double digits. And then I expect it to just stabilize out over the next 10 years. I can't go beyond 5 years. I never can, because it just doesn't make sense, especially when we have literally no guidance from the company at all. This is just estimations based off of what the whole industry is doing in total, how they're shifting from brick and mortar to online dealerships. But if we give them a 3 price to sales ratio, which I personally think would be a little bit more fair for these, we're sitting somewhere between 1.3 billion market cap and 900 million. Now, in stock price terms, 1 year, if it only had a 2 price to sales ratio, that would bring us to a 1071 stock price. That might not sound a lot because these little numbers are deceiving, but that is nearly 35%. Now, my bull case, which is one that I think it should be valued at with how crazy the growth is over the next 10 years, which is a 3 price to sales ratio. I could see it lying anywhere in between this, but there's no reason this thing should be sitting under a 1 price to sales ratio. Makes no sense to me. But that would present us with a $16 stock price, or 100% increase year over year. And finally, let's look 5 years out. This is pretty conservative, 50, 40, 25, 25. I had it really stabling out here because once again, I don't like to be aggressive here. So I like to use all of my conservative numbers. So that should show something about what we get here. My average case, which basically just means it stays at a 2 price to sales ratio, which I don't think it should drop to normal valuations until this thing's done growing. Even a CarMax is sitting at a 2 price to sales ratio, and that business is actually on a downward slope. So I just think this industry in total, as long as we're able to get the margins to be a pretty good amount, it's just set to take off. But even at this, if they get to these numbers with a 10% margin, that would put us at this same exact valuation. You could do the math if you want, or you could just trust me on that one. We still end up with $5 billion market cap, which is generally still not a massive business. It's just we're getting in so early. So if that was the case, in 5 years, I believe the stock price should be $63, and that would give us an annualized 5-year return every single year of around 40%, total return of 700%. Now the bullish scenario, that would give us a share price close to $100, about $94, with 1,090% total, which annualizes 118% a year. I don't know about you guys, but this seems like a good opportunity to me from a economical standpoint, from a actual fundamental standpoint. Now, I don't think they'll end up with a 10 margin. That would be pretty incredible. A 10% margin on a dealership, that would be very good. And that was just an example, but I do see these growth numbers being way, way higher. But as for the company outlook, over the next year, they expect 450 million, once again, which is a 130% increase. Some analysts are saying they might miss that. Who knows? They started off 2020 pretty slow for obvious reasons, but at the end, the last quarter was a 168% increase year over year. They hope to increase their unit sales up 120% all the way up to 20,900, and they hope to achieve a adjusted by the way, EBITDA margin of loss. So they're trying to get into the profit zone. Obviously, I don't expect this company to be profitable for the next 5 years. Honestly, I would rather them focus on growth and acquiring new assets, going into new states, creating more seller markets. You could buy from anywhere in the United States, but you have to be in one of the hubs to actually sell. So in this case, I think right now it's just Oregon, California, Texas, I believe, but they're growing so fast that might change by tomorrow. That's why I'm saying I believe, because last time I checked, you were able to use Oregon and California together, and Texas, of course. As for the balance sheet is one of the finest things that you're going to find from a SPAC company. A lot of cash on hand. That's something that the SPAC is going to do for them. It's exactly what it did in this case. You could see their total assets skyrocketed up, gives them a lot of money to work with cash of 233. That is pretty impressive. They have a lot of inventory compared to last year and a lot more property. This is something you should notice. All that growth is coming into a lot of property. Obviously, with that comes a lot of liabilities, but you guys can see the ratio here. It is a very good debt ratio. But now for my favorite part, technical analysis and my current position. But as you guys can see, we have been bottoming out at this exact range, right at the $8. That is a strong level of buying power, which makes a lot of sense to me. This is where I put in 300 shares just yesterday, and I'm looking to get more. I would like this to be a $10,000-ish position. That's what I like to build it out to, because genuinely, if it grows 1,000%, that would give us a really nice return, and that's just all I'm willing to risk, because there is still a lot of implied risk with companies like this that need to obviously live up to the expectations. If they don't get 130% growth, the stock will fall. I think anything above 100 will still keep the stock very strong. But as for the fundamentals, I think once this market kind of just turns around and stops acting up, we're going to see the next run. And I could see this thing lasting all the way to around 980. This is my pullback resistance here, where I think we could start seeing another dip. So just for you guys that want to do covered calls, which is a potential with this, if you buy the stock now, I would write calls at around $10-ish. That's where I'm going to be doing it at least. And with that money, I can buy more shares of Shift that will be absolutely free. That's my strategy with Shift, definitely. And I'm going to be continuing this strategy until this thing breaks out. Now, once it gets up to $9-ish, I don't see as good of a return. It's still going to be good long term, but short term, you're looking at a year rate of like 10-15%, which is still good, don't get me wrong. But I love what we're looking at right now, 30+% from Shift. But that is going to do it. Hopefully you guys learned something about Shift. Hopefully if you guys do disagree with me, you'll leave that down below. And if you do agree with me, give me some things that I missed here, because I can only fit so much into a short 10-minute video. But thank you for watching. I'll see you guys in the next video. Have a great day. Bye-bye.